what I'm about to say will annoy some people, but it's the absolute truth. Charts are the shadows, fundamentals are the object. So over the next 2 hours, I'm going to give you the ability to look at a currency pair, know exactly what's going on behind the chart, not just on the chart, so that you understand where this thing is most likely going to go next. Because every meaningful trend has a reason behind it, a fundamental reason behind it, why it's moving, why it's going. That may be an interest rate decision, that may be an inflation report, that may be the labor market, that may be a war, geopolitics, that may be just a change in expectations for what the big funds are expecting the fundamentals to be next. Because the thing is that money does not move randomly. You know, the big funds, big speculators don't move their funds around the markets, around currencies for no reason, or just because the chart has printed the bullish engulfing pattern or a pin bar or whatever, or the block. Funds move around for a cause, for a real event, a real cause that shapes expectations for what is going to happen next. And this cause is something that you can study, something that you can understand. And it's exactly what I'm about to show you in the next couple of hours. Because large funds move for repeated reasons. They move for the same number of reasons that you can understand. See, most retail traders spend years trying to master the shadow, the result of what actually shapes the shadow. Now, it does not mean the charts are useless. You're gonna see throughout this video that I reference technical analysis very importantly towards the end of the video, but we first have to understand the actual reason why things are developing the way they are. See, a chart is incredibly useful because it shows where money has already moved, where traders are positioned, and where you may want to exit or enter a trade. It defines the risk reward and so on and so forth. However, the chart does not tell you why the money is moving in the first place. So when you understand the reason and then use the chart for timing the entry towards that reason, well, then trading starts to look a bit different, you know. And it sounds cliche and over-promising, but stick with me here because it's going to make a difference in your trading. This is what I want to hand you today. I want to be precise about what you're getting here because this will not be a tour of 50 economic indicators, which is mostly what you see in the fundamental analysis videos out there. They define, you know, GDP, PMIs, NFP, PPI, ISM. They define all these economic numbers and then they leave you with a dictionary of terms and absolutely no idea how to trade them. We're not going to do that here. Okay, we're going to get into the practical aspect and give you the exact strategy that you can implement right away. So the model here has three main parts. Now in part one, we will understand central banks. You will learn what makes them move, what makes them nervous, what makes them change direction, and how to tell whether a central bank is becoming more supportive or less supportive for its currency. In part two, we will understand economic data, the data that actually matters. That's going to make quite a difference, and you'll see why. We will focus, in fact, mostly on inflation and the labor market. More importantly, I'll show you how to decide whether any piece of data changes the story or whether it's simply noise. Very important. And then in part three, we will add the risk sentiment part of it. We will use the US 10-year yield to actually give you a framework, a proxy essentially for the market's view of growth, inflation, fear, and we will build 4 regimes that will help you understand exactly in which type of fundamental sentiment the market is in and whether it's actually aligned with the central bank analysis and the economic data. So all these 3 points, you'll be able to align them to create high conviction trading ideas. We'll put everything together, all the 3 parts together, and we will compare 2 currencies, choosing the strongest, the one that has the central bank story supporting it, the economic data supporting it, and the risk sentiment supporting it, against the weakest, which is obviously the exact opposite. Then with this, we build a trade idea, define obviously the risk reward and what would actually prove the idea wrong, and build the trade from there. Now, hear me closely here, because then in all of this, you're gonna get an AI framework. So you're gonna be able to do 10 hours of this research in 5 minutes with artificial intelligence. I'm gonna give you the exact prompts and the exact knowledge that you need to actually make sense of what the artificial intelligence will give you. So by the end of this video, I don't want you just to be able to understand the basic definitions of what is GDP, what is inflation, and so on and so forth. I want you to be able to find the best macro trades to take, okay? I want you to be able to understand which currency has the strongest macro story and which has the weakest macro story, which obviously fits into finding the best macro trades. And then I want you to be able to trade and execute on that story with risk management at the right timing and so on and so forth. And this is in fact where technical analysis will come into play. And believe me, you're not gonna need an economics degree to do this. You do not need to predict every news release, and you do not need to spend 8 hours a day reading financial news. You just need a model. And now we're gonna build that model. So if you remember just one sentence from this video to begin with, I want you to remember this one. Funds seek the best return for the risk. Over time, money tends to flow towards the place offering the most attractive return for the risk being taken. A risk-adjusted return, essentially. So let's make that concrete. Imagine that you manage a very large fund. You can store your money in the United States, you can store it in Europe, Japan, the UK, Australia, Canada, Switzerland, New Zealand, whatever. You're constantly comparing the returns available in each place with the risk of holding the money there. Okay, we're not just looking at the potential return, we're looking at the return adjusted for the risk. If US rates, let's say, become more attractive, while comparatively speaking, Japanese rates stay low and become less attractive, then holding dollars rather than holding yen becomes more appealing. Same likewise if UK rates are expected to fall while European rates are expected to go high, same story. The pound becomes less attractive relative to the euro. Now, in all this logic, if the world suddenly becomes fearful of something that's happening, maybe it's a geopolitical event, maybe it's a recession and whatever and so on and so forth, you may stop chasing the higher return. You may want to need to start caring about safety, what we call a safe haven. This is why the complete sentence matters. It's return adjusted for the risk. It's not just the return, because otherwise you would just be long in the highest carry trade, the currencies that have the highest interest rates versus the currencies that have the lowest interest rates, and it will just work always. It doesn't work like that. It's the return adjusted for the risk. Money doesn't just chase the highest number, it chases the most attractive number for the risk being taken. This said, for most of the major Forex trends, interest rates expectations are where most of the story centers in. And then we're going to confirm that with the risk sentiment. So to start with, we're going to start with the central banks and interest rate part of it. Because every major currency has a central bank influencing the cost and the availability of money in its economy. The US dollar has the Fed, the euro has the European Central Bank, the Japanese yen has the Bank of Japan, the pound has the Bank of England, the Australian dollar has the Reserve Bank of Australia, the Canadian dollar has the Bank of Canada, the Swiss franc has the Swiss National Bank, and the New Zealand dollar has the Reserve Bank of New Zealand. These banks don't press buttons at random. Maybe sometimes they do, but that's just an extreme scenario. But 99.9% of the times, the people in charge of these central banks are reasonable people that actually move for certain reason which you can understand and you can use to anticipate what they're going to do. And what they do influences how attractive it is to hold their currency. And the main tools they use are mainly the interest rate, but let's go step by step, because before we get to that tool, we need to understand what central banks are actually trying to achieve. Now, the Federal Reserve is not trying to trade against you, the European Central Bank is not trying to hunt your stop loss, and the Bank of Japan does not care about their support level that you drew on the chart. Central banks have jobs to do. They have a task, a mandate. And that mandate is surprisingly simple to understand. They want prices to remain stable, and they want a strong labor market. Not exactly stable, they want maximum employment. They want the labor market to do well. Now, different banks describe those responsibilities differently. Some focus more on inflation than others. But as traders, we can simplify the practical problem into these two pressures. okay? Inflation and the labor market. And the first pressure is inflation. Are prices rising too quickly or falling too quickly or behaving exactly how the central bank wants? Then the second pressure is the labor market. Is the labor market weakening? Is it strong? Is the unemployment rate actually rising or falling? How is the labor market doing compared to what the central bank needs to do, which is support the labor market? They want a stable but also strong, supported labor market. And you're going to see exactly why both of these matter in regards to the economy itself. But step by step, what you need to understand is that central banks are constantly balancing the two mandates, the two sides. If inflation is too high while the economy is strong, well, the choice is usually straightforward. The bank can raise interest rates or keep interest rates high because the economy is strong enough to absorb the pressure. They got high inflation and a strong economy. So the labor market can withhold the higher interest rates that are needed to push inflation lower. But if inflation, for instance, is falling with the unemployment rising, so a weak economy with low inflation, well, the choice on this side also becomes straightforward. The bank can eventually cut interest rates because it has less inflation pressures. They're not concerned with the inflation side of the mandate. Maybe actually they're concerned with the fact that inflation is too low and the economy is also weak. So they need to cut interest rates to support the economy. These are the two straightforward scenarios. Then there's the more difficult environments because it's when these two sides actually conflict. Imagine inflation is too high, but the economy is also weakening. The unemployment rate, maybe it's also rising. So you got high inflation and a weak economy. Well, that becomes a bit concerning. That becomes stagflationary. So now the central bank has a problem because raising rates may help inflation but damage the employment side of their mandate. So cutting rates may help the employment side but actually doesn't help inflation because inflation is too high. It may actually end up raising inflation even higher. But that's another story. For now, let's keep it simple because this table right here, this quadrant, gives us the first practical question in this entire process. What is the central bank most worried about right now? Not what it was worried about a year ago. What is it actually worried about right now? If its speeches repeatedly focus inflation persistence, service prices, wages, well, the bank is actually telling you that inflation is the priority. That actually means it will be reluctant to cut interest rates and more willing to keep rates higher, okay, policy tight. If, on the contrary, the speeches begin focusing on the weak economy, focusing on the weak labor market, rising unemployment, whatever, then the bank is telling you that the economy is becoming the priority. That usually means it's moving towards cutting interest rates. So you're not going to need to decode every single sentence. You need to identify the problem they are most worried about right now. Is it the weak economy? Is it high inflation? Is it maybe a strong economy? Is it maybe low inflation? So I like to keep things practical. So one thing that you can do right now is to go on ChatGPT and ask to analyze the central bank, analyze the Reserve Bank of Australia right now, and find me whether they are more concerned about the labor market side or the inflation side of their mandate. This alone will tell you which side of the mandate the central bank is actually more under pressure with. And the reason why this is so powerful is that central banks have consistent goals. They want something. They're not perfectly predictable, but they're systematic. If you understand the problem they are trying to solve, you can begin to anticipate the action that they are likely to take. So if you know the data, if you know which side of the mandate actually they are more concerned about, well, you can understand the pressure. And if you understand the pressure, you can anticipate the central bank. And if you can anticipate the central bank, you can begin to understand the currency. That chain is the entire spine of this entire guide. But let's see what actually ChatGPT said here. Right now, this Reserve Bank of Australia is more concerned about the inflation side of this mandate than the labor market side. Completely true. In fact, the Reserve Bank of Australia is one of the most hawkish central banks right now, with one of the highest interest rates in the G10. Now, we got a fairly weak labor market report today, but the fact that they are more concerned about what? Their inflation side of the mandate, this weak employment report does not change the picture. Because as ChatGPT said here, I will describe the Reserve Bank of Australia economic reaction function has roughly 70% focused on inflation and only 30% focused on the labor market. And it goes on explaining why inflation is still dominated. It goes on explaining what the governor of the central bank said, and this is extremely useful. You can get as much as information as you want from artificial intelligence. And towards the end of the video, in fact, you will see exactly how to put all of this into a framework that you can use repeatedly. That said, let's start to look at the main level that the central bank can use to actually address the high inflation, address a weak economy, and so on and so forth. And that is the interest rate, the most classic tool that they have to use. You heard about it consistently. The Fed raises interest rates, the Fed cut interest rates, the European Bank raised interest rates, the European Bank cut interest rates, and so on and so forth. However, I want you to understand this action as a macro trader rather than just an economist or boring headlines. The simple version of this is that central bank raise interest rates to slow demand, and they cut interest rates to support demand. Demand for what? Demand for goods and services in the economy. When interest rates rise, borrowing, for whatever reason, for a house, for purchases, for investments, and so on and so forth, becomes more expensive. A mortgage becomes more expensive, business loans become more expensive, saving becomes more attractive because you get a higher interest rates. Treasuries, bonds will get more attractive, and we will get into this later into the video, because you get a high interest rate. So people, investors, tend to spend less and demand cools down. Because of demand cooling down, inflation pressures also start to moving lower. Okay, so the central bank raises interest rates to lower what? Inflation. And the opposite is true. When interest rates fall, investments, borrowing, they become more attractive because the fixed saving, the fixed interest rates that the people get on savings, on treasuries, and so on and so forth, becomes less attractive. And so demand starts to get supported. And they do this to spur up inflation. Okay, they do this to raise inflation up. Because why? They want inflation around 2%. Most central banks, not all central banks. Most central banks want inflation around 2%. If it's too high, well, they need to raise interest rates to bring it towards 2%. If it's too low, they need to cut interest rates to support inflation. That is the economic side. Now let's connect this to the currency. Suppose the Federal Reserve raises interest rates while the Bank of Japan keep interest rates much lower. Well, dollar-based assets now offer a more attractive return relative to what? To Japanese yen, to Japanese-based assets. A large investor who wants that high return, high yield from US treasuries, from US stocks, from US investments, whatever, what they need to do, let's say they are a Japanese investor, well, they need to sell Japanese yen to buy the dollar to then invest into the high yielding assets, whatever that's stocks, whether that's treasuries, and so on and so forth. So demand for the dollar, because of its high yield, increases. And that supports, for instance, the dollar against the Japanese yen. When that gap moves in the opposite direction, so for instance, there's a lower yield in the US and the Japanese yen, maybe the yield of the Japanese yen remains the same, well, this dynamic goes to the opposite side. So people start exiting the high yield because now it's not a high yield anymore of the US dollar, and then they go into whatever they want to go. So the advantage of holding dollar denominated assets becomes less attractive. So some traders no longer want that position and they start to unwind back into their original position, in this case the Japanese yen. This is the basic mechanism behind interest rate differentials. Higher rates equals a more attractive currency. Lower rates equals a less attractive currency. And by the way, notice what we're doing here. We're doing a comparison. This is a relative analysis of one currency versus the other. See, what you need to understand about fundamentals is that you're never trading one interest rate in isolation, despite the fact that, I have to admit, the US dollar interest rate actually moves pretty much everything, okay? So if the dollar moves, you can have the highest yield somewhere, but if the dollar moves interest rates, it's gonna move everything. But we'll get to this later. For now, keep it simple and understand that you're never trading just one currency in isolation. It's always a good idea to keep in mind that when you analyze a currency pair, you're analyzing one currency pair against the other, okay? So let's take the euro against the dollar. If the Federal Reserve is becoming more hawkish, while the European Central Bank is becoming more dovish, so hawkish means that the central bank is looking to keep interest rates high or potentially hike interest rates, while dovish means the central bank is looking to keep interest rates low or potentially bring interest rates even low. So in this scenario, the dollar side is improving while the euro side is weakening. And that creates a clear divergence and can give the euro against the dollar a clear reason to fall because the dollar is becoming more attractive compared to the euro. But if, let's say, both central banks are becoming hawkish, so both central banks want interest rates high, well, then there's no clear advantage in these two currencies competing to each other. The same goes to the opposite side. If both, for instance, are cutting interest rates, so wanting to keep interest rates low or cut interest rates, well, if they're moving at the same speed, with the same conviction, there's nothing much to do. But Forex is a competition. So you could argue essentially who is cutting faster and who stops first. So who has the best conditions to cut interest rates faster and who has the least conditions to cut interest rates faster. It's getting a little complex here, but follow me through because it's gonna make a lot of sense throughout the video. What I'm trying to tell you is that you should put strength against weakness. The best positioned currency based on its context versus the weakest currency based on its context. We're not just telling long a currency that is strong on the chart versus a currency that is weak on the chart. No. Those are the strength indicators that just are useless, okay? We're looking about economic strength and not just economic strength, but monetary policy strength versus monetary policy weakness. Okay, now you heard me say these two words already throughout the video, hawkish and dovish. These words sound like unnecessary financial vocabulary, but these ideas are useful and very simple. A hawkish central bank is a central bank that is concerned about inflation and more willing to hike interest rates, as explained, keeping interest rates high or even maybe delaying rate cuts, versus a dovish central bank, which is a central bank that is more concerned about weakness in the economy, in the labor market, or in inflation, and wanted to keep interest rates low or maybe even cut interest rates. Now, this is where traders start making mistake with fundamentals, because here is a scene that plays out at a central bank meeting most of the time. A beginner learns what? Like I said, that rate cuts are dovish, and as explained, a dovish sentiment or a rate cut is bearish for the currency because it lowers its attractiveness. Well, then a Fed meeting arrives, the Federal Reserve cuts interest rates, and what does the beginner do? Because he learned exactly what I just explained, but it stopped there and it didn't go through the video because you're gonna see exactly where this goes later. But what happens is that it just is content with understanding that hawkish means bullish and dovish means bearish, and rate cuts means bearish and rate hikes means bullish, and he sells the dollar on this rate cut. Great. What happens? The dollar rallies on the rate cut. It dumps just a little bit on the announcement and then it rallies back up. Now, what does the beginner do? Well, he says that fundamentals are useless. Look, the Federal Reserve cut interest rates and the dollar rallied. Why? Because he stopped before actually the full understanding. Let me get into it. The market had expected the rate cut for weeks. Traders had already sold the dollars. The smart traders, the speculators, the informed speculators sold the dollar in advance heading into the interest rate decision. And the probability of that interest rate cut had already been priced in. By the time the interest rate cut happened, it was old news already. It got a tiny spike further into the supposed direction, but then it unwound back towards the opposite direction. Why? This can happen for multiple reasons. Now, all the speculators that position heading into the Federal Reserve, understanding by looking at the labor market and inflation that the Federal Reserve was going to cut, they positioned into the meeting and then they started to taking profit after the meeting. Or what can happen is even worse, that the Federal Reserve may have cut interest rates, but then projected that they didn't expect any more cuts. And what is that? Hawkish, despite the interest rate cut. Because what you're going to learn in fundamental analysis is that expectations move the market. what happened 5 minutes ago matters less than what is going to happen ahead. Markets do not trade what happened, they trade what comes next. If you understand this sentence, you are ahead a lot in fundamental analysis, because the currency market is a forward-looking pricing machine. The price that you see on the screen already contains the market's best guesses for what the central banks are likely going to do over the coming weeks and maybe even months. Therefore, the question is rarely what did the central bank do today. It matters for the short-term reaction, for the minutes into and after the event. But beyond that, what matters is what did today's information change about tomorrow, the expectations of what's going to happen in the next couple of weeks and months. That is the difference between trading what happened and trading what's next. And believe me, that's the single biggest thing you need to understand if you want to trade fundamentals correctly. You have to focus on what's next, the expectations out of the event for what happens next. That's what moves the market, because the expectations into the event are also the expectation of what happened next, because at this point you're pricing what's going to happen into the event. The event happens, the move happens accordingly in the minutes of the event to what's expected, but then the trends, the swings after the event are dictated by what's going to happen next, the expectations out of the event. This is not a mathematical formula you need to calculate, but it's a thinking tool. Whenever a decision or data release arrives, ask what the market expected before the event and then what it's expected after the event. And if nothing meaningful changed, then there's nothing to do. And this is where fundamental analysis starts to get serious. So, what I'm about to show you is the framework that will bring clarity and sharpness to your fundamentals, so that you know exactly what you need to focus on and what you need to filter out. I want you to picture every new piece of market information entering a large funnel. Every inflation report, every labor market report, every growth update, GDP, speeches, election results, geopolitical headlines, everything enters the top of the funnel. And the funnel asks one question: does this information change what the central bank will do next? If the answer is yes, then expectations of what the central bank will do next move the market, because that's going to make the currency more or less attractive based on the fact that the central bank is expected to hike interest rates or cut interest rates and so on and so forth. Most of the time, this is how you should process economic information. When a number drops and price behaves, whatever it does, walk through the funnel. What did the market expect into the event? What did it receive? And then, does this change what the central bank will do next? Does this make a difference towards an expected rate hike, an expected cut? Or does it make a hold more likely? And so on and so forth. If you cannot explain the move through that process, well, just don't invent an explanation, okay? Don't trade data just for the sake of trading data, just because you feel the need to trade. Sometimes the information is just mixed. Sometimes another story is in control, and sometimes the correct decision is to wait. You're gonna find that a lot of time in fundamental analysis. The best decision sometimes is to just wait, because it's not clear enough, it's mixed, and whatever. That's not weakness, okay? Deciding not to trade a story that you cannot explain, that you cannot make sense of, that you don't think it's clear enough, is just part of being disciplined. Okay, so up to this point, we've talked about expectations, great, but how do you actually see expectations? How do you actually understand expectations? Well, one of the simplest places to look for is the bond market. And before we get into it, there's one basic relationship you need to remember. Bond prices and yields move in the opposite directions. When bond prices rise, the yield falls. When bond prices fall, the yield, so the interest that the bond pays, rises. Now, you don't need to become a bond trader, you only need to understand what the yield is communicating. So government bonds come in different lengths. You can lend money for a few months, so the government essentially borrows money from investors, either for a few months, for a few years, or for quite a bit of time, much longer, okay? For our purposes, the 2-year yield and the 10-year yield are the most useful. The 2-year yield is the faster policy signal. It responds strongly, very strongly to what the market expects the interest rate to go. When it falls, it means it expects interest rates to fall. When it rises, it means it expects the interest rates to rise accordingly. This is the 2-year yield. It's basically a straightforward instrument that prices what the central bank is going to do next. Then the 10-year yield is a bit of a different story because it reacts, yes, to expected interest rates, but it also absorbs the market's view of growth, inflation, and the overall health of the economy over a longer period of time. So for now, remember this distinction. The 2-year yield is the central bank's expectations, and the 10-year yield is growth, inflation, and the central bank's expectations, but also sentiment, mood for economic growth. In fact, you'll see that later we will use the 10-year yield as our simple risk sentiment proxy because it encapsulates the sentiment, growth expectations, inflation expectations, and so on and so forth. Right now, I want to show you how yields help with currencies though. So open up the 2-year yield for the 2 economies that you want to track and the currency pair that you want to monitor. In this case, the euro against the dollar. We're looking at the 2-year yield for Europe and the 2-year yield for the US. In orange, you're looking at the European yield, and in blue, you're looking at the US yield. In this case, what you're seeing is that the US 2-year yield is falling while the European equivalent is rising. So the rate story in this example is moving in favor of the euro against the dollar. So the market is pricing potentially higher interest rates for Europe versus potentially lower interest rates for the US. This is what you're seeing in this chart. That gives the euro against the dollar a reason to move higher. Because the euro is getting more attractive, it's starting to potentially yield more than the dollar. Yields are moving higher for Europe and lower for the dollar, making the euro against the dollar more attractive. Now, it's not straightforward, as you can see, but it's the trend. This dynamic of potentially higher interest rates in Europe versus potentially lower interest rates in the US, it makes the euro against the dollar more attractive overall. Now we can see another example, same story, just slightly different, where we have European yields here still in orange, flatlining, coming down a little bit, but compared to a much lower US yield. Again, a market diverging a little bit, making what? The euro against the dollar more attractive overall. It gives you the trend, okay? The expected path of interest rates gives the trend. So with this dynamic of understanding the relationship between yields in different countries, which makes a currency less or more attractive, is where you can also start to build a nice little dashboard on TradingView with all the 2-year yields from the currency you want to monitor to see which one is performing better and which one isn't. And that quickly gives you a macro bias to study in more in depth. It's a starting point essentially. If you see an interesting move in the yields, and you go deeper in understanding why is the move occurring. Now, I have to be honest here because I personally don't like to do this way. Meaning, I know some traders who really like this type of setup dashboard where they look at every yield and see how they're doing. It's useful, yes, but for me, it's not really my thing. I like to understand the story a bit more in depth. It's a good starting point. This dashboard is just a good starting point, but make sure you're not stopping yourself on the dashboard because there's much more to it and we're gonna get in fact into the video. But the process is simple. First, look at the direction of the 2-year yield for currency A. Second, look at the direction of the same yield for currency B. Then ask whether the gap between them is widening or narrowing. So look at the chart and see if the gap is widening or narrowing. And fourth, check whether the currency pair agrees with that story or not. Okay, so if the currency pair is moving accordingly with that, if technical setups agree, if the trends agree, and so on and so forth, then you have a trade. We're gonna get into this technical part later into the video, towards the end of the video, because it's very important. Now, what we just did here is actionable bond market analysis without turning your trading desks into an economist classroom, okay? Now, why does this matter? Why is the yields move currencies so much? The answer, carry. When you hold a position overnight, what happens? Your broker may pay or charge an amount often called a swap, a rollover fee. I'll call it a swap. That amount is connected to the interest rate difference between the two currencies. Now, some brokers adjust it a little bit for their own costs and adjustments, but if you're with a reputable broker, most of the time that's going to be the exact interest rate differential. So what happens is that if you hold the higher yielding currency and fund the position with the lowest yielding currency, you're going to receive a positive swap. Now, holding the higher yield currency means longing the higher yield currency, and funded by the lower yield currency meaning shorting. So let's say you're longing the dollar with 4% interest rates versus the Swiss franc with 0% interest rates, then you're going to receive the differential of that in swaps overnight interest. Okay, now scale this idea far beyond a retail account. Swaps for you may be a little small, not exceptional, but imagine you're holding hundreds of millions of a portfolio and you have to decide where to put that to gain the best interest. Well, when US rates are much higher than Japanese yen, for instance, Japanese rates, large traders are going to borrow or sell short the Japanese yen and hold dollars or dollar-based assets. They're being compensated for maintaining that position. So the trade can attract more money while markets are calm. Okay? As long as volatility is low, as long as the markets are quiet, you just get paid to wait. And even if the dollar against the yen doesn't do anything, there's still the positive swap. And if the rate advantage grows, so if interest rates go even higher in the dollar and stay flat or maybe even go lower on the Japanese yen, well, that position becomes even more attractive because the advantage and the positive carry grows further, which means the opposite is also true. Okay? If that dynamic reverts, it becomes less attractive. Because here's a caveat which we're going to get into soon. If it happens that fear suddenly explodes, volatility rises, things become uncertain, well, in that case, traders may choose to close the position, close the carry trade, even if the carry looks still attractive. Because at that point, protecting capital becomes more important than collecting yield. Remember, it's return adjusted for what? For risk. Return by itself means nothing if risk is too high. So carry works until the risk of holding becomes bigger than the return itself. Understand where I'm going? It will get a lot deeper into more details later into the video. So funds don't just chase yield every time just because it's high. Money seeks the best return for the risk. When the risk is in check and there's no concerns, well, carry trades work great. So this differential between a currency with high interest rates and a currency with low interest rates works great. When fears start to hit, carry trades start to get hit as well. Okay? Now, before we move into the next big part of this video, the economic data, let's consolidate what you've learned so far. So for each currency, ask what the central bank is most worried about right now. Decide whether the bank is becoming more hawkish or more dovish, maybe remaining neutral, whatever. Do not focus just on what happened before, but focus on what the market expects the central bank to do next. Look at the 2-year yield. Is it rising? Is it falling? That signals attractiveness or not of a currency in the chart. Compare the attractiveness of two currencies. Which one is getting more attractive? And with all that, analyze if there is a real divergence between two currencies. If you can't find this contrast, you don't have a clear central bank trade to take in this case. So all this understood, this is all theory that we're now going to start to put into practice by understanding the next big important part, which is economic data. Now, open any economic calendar, in this case Forex Factory, and look at a normal week. You may see manufacturing service, construction numbers, confidence index, trade figures, housing data, speeches, inflation releases, unemployment reports from all sorts of countries. Now, the beginner what does? He looks at this calendar and assumes that becoming a good fundamentals trader, becoming good at fundamentals, means learning to understand and react to all of this. This is exactly how traders become overwhelmed and they abandon fundamentals. Because they treat every red folder as important, they treat every event as important, every surprise as a signal, even a tiny surprise, and every bit of volatility coming from the data as a trade to take. And that's gonna burn them out. If you chase this, you're gonna spend every week reacting, but not actually doing much. So you have to stop and ask whether this information that you're looking at actually changes anything. Anything what? What it means anything. Anything that I've just explained to you. Does this change what the central bank is going to do next? Okay? So here is the filter that removes most of the confusion on the economic calendar. The question you have to ask is, does this change the central bank story? Every economic data must be put through this filter. Does this piece of information change what the central bank is likely to do next? If it changes the probability of a hike, a cut, on a hold next, well, it matters. If it changes the timing of the action, maybe the central bank was expected to hike in 2 meetings time, but now the data is forcing them to potentially hike at the very next meeting, well, that data is going to matter. Maybe it changes how the central bank may need to be aggressive. Maybe they're looking at a 25 basis points and now the data may force them to move by 50 basis points. Well, then the data is going to matter. It's all relative to what the central bank is looking at. It's all relative to what the central bank cares about. If you understand, if you put your mind into the central bank, if you think like a central bank, you're going to start to look at the economic calendar completely differently, okay? Because you know exactly which data is going to matter for the central bank and which data is going to move the needle for the central bank. That's going to remove 80% of the noise and it's going to keep the 20% that actually matters. This part in understanding the economic data, this part of the video is going to go exactly through that. So you're going to have the exact framework that will teach you how you should read, interpret, and filter the data. So whenever an important report is released, you have to ask 4 questions in the same exact order. First, what did the market expect? Second, what actually happened? The analysis of the data. Was it as expected? Was it more or less than expected? Then, were the important details consistent or mixed? Now, the details here is what I think 98% of retail traders never heard about or never know because it's not in the economic calendar. For instance, we're going to look at the NFP revisions. We're going to look at the components of the NFP. Those details are going to matter. And fourth, again, the same exact question. Does the complete report, so the whole of it, change what the central bank will do next or not? This is the process, the checklist. Now let's go through each and every one step by step. The first question is what the market expected. Because a number has no meaning in isolation because the market moves on the difference between the expected outcome and the actual outcome. Suppose inflation comes at 3%. Now, is this hot or is this cold? Well, it depends. You can't answer until you know what traders, what the market, what consensus, what economists, analysts expected. If they expected 2.5%, well, this 3% is hot. It's a lot higher than expected. If they expected 3.5%, then this 3% is relatively cool. It's relatively soft. So the same number, 3% inflation, can be seen in completely opposite ways, depending on where expectations started from. The second question is what actually happened. So this is the headline number. So we understand in this case inflation might be 3%, but then we also gotta get into the details of this and we'll see how to get into more details later into the video. And so the third question links to this in understanding the details. Were the important details related to that 3%, related to that inflation batch of numbers, consistent or mixed with the headline number that you see? See, a strong headline number, 3%, let's say, with weak underlying details is different from strength across the entire report. Now, a clean report is every important part points the same way, inflationary or deflationary. A mixed report is when things start to get mixed. Maybe a part of the inflation batch of data is inflationary and another set is deflationary in the same numbers. And for instance, with the NFP, this is very clear as well. Sometimes the headline number can be one figure, but then wages might be different and they might conflict, and that makes the report that mixed. You will see some real practical examples later into the video. Now, the fourth question, when you look at the data, is to understand if it changes something. I've repeated this often during the video, and I'm going to repeat it again. Does this report, does this number that is just being released make a hike, a cut, a hold more likely? Does it move something for the central bank? Does it move the timing of their decision? Does it move how aggressive they may be? If nothing for the central bank changes, well, the data doesn't give us anything interesting to trade. It hasn't moved the needle, so to speak. So this distinction is critical because often, very often, with the data, you may see volatility, but volatility doesn't mean a new trend is starting, something that you can trade, okay? That distinction is critical because a large candle tells you that something has hit the market, okay? Some orders hit the market. In this case, when it comes from an economic data, the very first reaction are algo-driven, okay? It's very high-frequency traders, algorithms that react programmatically to the headline number, which does not reflect the sentiment of the big speculators, okay? It's volatility. It doesn't mean necessarily direction because it's algorithms that are simply reacting programmatically to the number that they see on the screen. Then the details, then everything I've just talked to you about, decide whether the move continues or not. Okay, so the objective is not to race with the algos. You got no competition with the algos, okay? They're very fast, they're high frequency. You can't compete with them. What you can do instead is decide whether the information that has been released created a direction that may still matter after the initial reaction. So you can decide whether you want to fade or whether you want to actually position for a continuation. There's two different types of reaction to the data, either spike and fade or a continuation. And the difference in this is decided by the details of the numbers and whether the new information that I see in the market actually changes something for the central bank. In this case, we get a continuation, or it's just noise. In this case, the market fades and nothing happens. Nothing changed, essentially. Okay, all this said, let's begin diving into the data one by one, starting obviously with inflation. Inflation is the speed at which the general prices of goods and services rise. If inflation is 3%, that means the broad basket of things costs roughly 3% more than it did a year earlier. Inflation is simply the speed at which prices rise. Now, most major central banks aim for inflation at 2%. They don't want things too cold and they don't want things too hot. They want inflation stable around 2%, which means when inflation is too high and rising, while the central bank has pressure to raise interest rates, maybe keep interest rates high, keep policy restrictive for longer in order to bring inflation back to 2%. On the contrary, when inflation is too low or falling convincingly towards target, maybe it's falling so fast and so well that the central banks may want to front run the fact that it may fall below 2%. And so what they do, they start to cut interest rates or wanted to keep interest rates low in order to make sure that inflation then stays around 2%. So the practical chain is extremely simple, okay? Hotter inflation creates tighter policy pressure, which supports the currency because tighter policy pressure means higher interest rates. And if you have understood everything I've just talked to you about in the first part of the video, you understand that higher interest rates and higher expected interest rates means higher yielding for that currency, which means currency support. Now, cooler inflation is obviously the opposite. That means interest rates may need to fall or be kept low, which reduces the attractiveness of the currency. However, remember the two conditions that we've already learned, okay? The result must be put into context with what the market expected, okay? An inflation report that everyone expected does not automatically create a trend. An inflation report that changes instead what the central bank may do, what that is going to move the needle, okay? I'm going to show you some examples soon. But now, what we can get into is the details exactly of the report that you'll see and you'll find, in this case, for instance, on Forex factoring. So the most widely followed inflation release is the CPI, the Consumer Price Index. Most countries release some sort of consumer inflation report, normally once a month, sometimes once a quarter, depending on the country. Now, what you absolutely need to understand here is that you'll see two different types of inflation reports. You'll see on Forex factoring particularly just written CPI. When you see just written CPI, that means this is headline. Headline CPI is basically the full basket. It includes energy, it includes everything that can be calculated. Now, core CPI instead is what the central banks most focuses on, because core inflation attempts to remove some of the most volatile components that feed into CPI, so that the market and central banks can see whether price pressures are broad and persistent rather than just being created by a temporary move, for instance, in oil prices. Because, food and energy prices can rise sharply maybe because of weather, maybe because of a war or a supply disruption in the oil market. Those changes obviously matter, but central banks may hesitate to redesign their interest rates around that, because often this type of disruption, whether wars, maybe a temporary disruption in the supply in the oil market, which is driving prices higher, temporarily spiking inflation, but then again it's temporary. So what the central bank does is often they overlook the headline number and they focus on core CPI, because they strip down the volatile components, and core CPI focuses on exactly the broad pressures of inflation. Then what happens? If the energy disruption becomes too long, too consistent, then it starts to feed into core CPI, and then that's when the central bank starts to care about it. Okay, so what I want you to keep in mind is the distinction between core and headline inflation. Core CPI is 90% of what we're going to focus on. Headline CPI is useful for context, but keep in mind the central bank is going to focus on core CPI. Now, this distinction, as explained, often is just simply on Forex Factory, it's written CPI, it's headline CPI, and on core, it's written core CPI. There's a distinction to make because for other countries, for instance, for Australia, you will see often this. In this case, the main CPI, again, is just written CPI. This is headline CPI. And then core CPI for Australia is trimmed mean CPI. Trimmed mean is the equivalent for core CPI in the US. And in fact, the trimmed mean is what the Reserve Bank of Australia mostly focuses on. Similarly, for instance, for Canada, you'll see, again, CPI is just headline CPI. And then you'll see median CPI and trimmed CPI. These are the two core inflation measures that the Bank of Canada focuses on, okay? Median CPI and trimmed CPI for the Canadian dollar. Anyway, anytime you have doubts on these, just ask to ChatGPT. For instance, you can ask it what measures of CPI does the Bank of Canada focuses on. It'll give you a pretty accurate answer. So that said, the reason this distinction is important is that the underlying inflation that the bank focuses on, it's what allows us to understand what they're going to do next. And that's going to create the base and the framework for the trades. So here's how we can read a CPI release in practice. Start with the expectations of what headline CPI was and what core CPI was. Then you can compare the actual reading with the expectations. So maybe inflation was expected at 3% and it printed instead 2.6%. Well, that's a soft CPI number. Then read both the year-on-year number and the month-on-month number. Both matter. I tend to prefer to focus more on the year-on-year number because that's what gives me the straightforward look with the central bank's target, because the central bank's target, they target 2% year-on-year number. The monthly number is useful, the month-on-month number is useful, but I focus more on yearly. Both are part of the same batch of numbers, so they both matter. But what I want you to focus on most is the component that the bank has been emphasizing. Obviously, in this case, as I've said, core inflation, trimmed and median CPI, for instance, for Canada, trimmed mean CPI for Australia, and so on and so forth. You have to make sure you focus on the exact number that the central bank is looking at, because you want to understand what they're going to do next. And the way you do that is by understanding what they're looking at, okay? And again, if you need assistance in this, just ask ChatGPT to tell you what such and such central bank is most focused on when it comes to inflation and so on and so forth. And then once again, this comes back again, ask whether the data changes something for what the central bank is going to do next. Okay, suppose the market expected the central bank to hike in 3 months. Inflation then prints much softer than expected. Okay, core inflation. So what the central bank focuses on, both the month-of-month number and the year-on-year number. Expected 2.8, expected 0.2, and it comes much below forecast. Everything is soft here. Headline CPI, the details, the month-on-month number, everything is soft here. The useful conclusion here is that CPI is not just soft, it's actually much softer, and this is going to change what the market expects from the central bank. The market was expecting, in this case, the Federal Reserve to potentially hike in a couple of months, but now inflation is much better than expected, and potentially this hike is gone out the window. And this is exactly what can start a trend. This is exactly what can start a trend that you can ride. As you can see here, this event caused the 2-year yield, which is what? The straightforward expectation of what the central bank will do next, started dumping because the market started to price out the potential rate hike from the Federal Reserve, and the dollar, of course, followed. Not just with the initial reaction, but also with the reaction after. Why? Because the data that was released changed expectation for what the central bank was likely going to do next. Before the data, the market was expecting potentially a hike. After the data, this set of numbers changed expectations and removed the potentially need for that hike. Okay, so with core and headline inflation, you've got pretty much inflation understood and sorted. But CPI is not the only inflation information that you will encounter. So let me try to keep it simple. What you need to understand is simply that in the United States, there's also PCE, which is the Federal Reserve preferred inflation metric. It's simply called, again, PCE. Then you have the PPI, the Producers Price Index. It's useful as sometimes a bit of an early warning, potentially, because PPI ends up feeding a lot PCE. And then there's wages. Wages are what I see traders very often ignoring. But it's very important because wages feed directly into households. When wages rise, households have more income to spend, and businesses face higher labor costs. So wages can create a type of inflation that is hard to remove, because once you raise wages, well, it's hard to bring them down. This is why the central banks pay close attention to wage pressures, because the labor market can look calm through the unemployment rate, but wages might be telling the central bank that domestic inflation is rising. And when domestic inflation through wages rise, well, there's some concern there. It's a type of inflation that is really sticky. So for your analysis, you don't need to complicate the analysis of these numbers, okay? You just have to place inflations into one bucket. You have to understand if price pressures are hotter, cooler, or stubborn. How is inflation doing? Is it hotter than expected? Is it cooler than expected or not? Is the direction consistent across the various inflation metrics? Headline inflation with core CPI inflation, with PCE, with maybe PPI as well, with maybe even wages, the whole bucket of inflation. And then the batch of numbers, everything together, does this change the reasons for what the central bank is going to do next? So is inflation so hot that it's going to trigger the Federal Reserve or whatever central bank to tighten interest rates? Maybe inflation is coming down so fast across the board that maybe it's going to trigger the central bank to ease interest rates, or just do nothing. This is what you need to produce. This is the question that you need to answer. And the answer is going to tell you what the currency does. Because as we saw in this example right here, a soft CPI that changed the expectations for what the central bank was going to do next creates a nice tradable trend. Now let's move to the labor market. Why does employment and the labor market matters for currencies? Well, a strong labor market means that more people are earning income, consumers can continue spending, and the economy can actually withstand higher interest rates for longer. A weakening labor market means the opposite. Demand may slow down, and the central banks may need to start to support the economy. So the chain is simple, okay? A stronger labor market normally gives less reasons for the central bank to cut. With a strong labor market, they may need to potentially hike interest rates or just keep interest rates high. While a weak labor market, then that's when the central bank needs to start thinking about potentially rate cuts. Obviously, the most famous labor market release in the US is the non-farm employment change, the NFP. Most traders just stop just at this number and the unemployment rate, and that's all they know about the labor market. There's a bit more to that. The NFP is not just one number, but it's a package of numbers. The first part is the payroll growth, okay? The headline NFP, whether it's 100K, 150, and so on and so forth. The second number then is obviously the unemployment rate. Then you got wages. As I've explained, wages are very important, often overlooked, but very important for the inflation story. All of these three, payroll growth, unemployment, and wages, are released on Forex Factory. But this is where it gets a little trickier, because this part right here is not released on Forex Factory. These are the revisions to the prior NFPs. This is the participation rate, and these are the weekly hours. These three can completely change the message. You may see something in the headline, in the surface, and something else below the surface. And the market is going to care about what's below the surface. So let's start with the revisions. The revisions, if we go, for instance, to the BLS website where the NFP gets published, at the very bottom you'll find the revisions. So you can just go directly to the official bls.gov website and you'll find the full NFP report, and at the very bottom you'll find the revisions. So what I'm trying to make you understand here is that the headline NFP numbers that you see on Forex Factory is often not just enough, okay? You gotta look at the revisions, you gotta look at the participation rate, and the weekly hours as well. Now, to make it practical, here's what you can actually do. Anytime the labor market prints in the US, so the NFP, you can go on ChatGPT, you can take the link of the labor market report, paste it into ChatGPT, and then ask it, give me all the details I need about this latest labor market report from the US, tell me wages, tell me exactly the revisions what were, and create a complete full picture of how the labor market in the US is doing. Now, obviously, you can build a bit more on this. This is just a prompt that I came up on the spot, but simply ChatGPT here is going to do all its research, and it's going to tell you exactly all the details that you need, not just the surface level, but the underlying deep level. As you can see, it just already caught the revisions, so it understands that the prior two NFPs in this case were revised much lower, and that's going to create the complete picture. It's going to understand wages, the participation rate. So in this particular case, for instance, the unemployment rate fell to 4.1%, as you can see here. Second nuance matter, the unemployment rate fell to 4.1%, but for a weak reason, because the participation rate fell. Now this is so important. If you want to understand fully the data, don't stop on the surface headline numbers. You have to go deep, because in this case, a lower unemployment rate, for instance, was actually bearish for the dollar. And if you actually follow us on our public Telegram channel, you will remember, you will know that this is exactly what I've told you. The unemployment rate fell, so the data was mixed. No, it wasn't mixed. Why? Because there are two ways to make the unemployment rate go down. People get hired, that's a good one, or people exit the labor force, that's the bad one. And in this case, the unemployment rate fell because of number two, because people exited the labor force, which is exactly what ChatGPT here came up with as well. So the NFP in this case, despite the lower unemployment rate, was negative, because if you stop at the surface, you're gonna get caught, okay? If you then go deeper, you'll understand the details. And so this is actually why we went long the pound against the US dollar, because we understood that the data was enough for the Fed to not hike, because the labor market was weaker. The headline number was weak, but also revised lower, so much lower than expected. Wages as well were much lower than expected. You see what I'm doing here? Exactly what I'm showing you in this video. Exactly what I'm teaching you here. Don't stop just on one number. Go deeper. Understand wages. Wages were soft. The headline number was soft, but not just that, because also the unemployment rate fell because people exited the labor force, and we got the revisions to the prior NFPs. And with this prompt on ChatGPT, you can see all the details you need. The revisions are arguably the biggest story. That's true, because the prior two NFPs were revised lower by a lot. why the unemployment rate falling is less assuring than what it looks. This is so much, and I'm not sure what I'm actually giving out for free on YouTube, but just make the best of it. Understood? Not just the headline numbers. Focused on all the details because it matters. Okay? So, payrolls versus expectations, the unemployment rate, wages, revisions to the prior NFPs, participation, to explain why the unemployment rate is moving. All of this will give you a full picture for the labor market. And you don't need to be an economist to do it. You just need to understand how to use ChatGPT. So for instance, let's say an NFP is much stronger than expected. So forecast at 85K, it prints 140K. Now in this case, the dollar obviously jumps immediately because what? Because algos react to just the headline number, they programmatically react to the upside surprise, and so they quickly buy the dollar. But they do it in microseconds, they do it in milliseconds, not something that you can actually do manually, okay? So what happens if you start to chase this, you're gonna get caught in the underlying details because we see the wages here are softer and the unemployment rate is actually higher. So what happens? The move fades out. Full picture that makes the picture, okay? Now, we've covered inflation and we've covered the labor market. What about all the rest? What about GDP, PMIs, retail sales, the housing market, confidence indicators? Look, I'm gonna make it as straightforward as I possibly can. They are supporting evidence, but they're just supporting evidence until the central bank says that, hey, maybe we wanna look at retail sales, maybe we wanna look at the housing market. Once the central banks makes that the base case for their decision making, then it's gonna matter. But until then, it's supporting evidence, just supporting evidence. For context, for instance, obviously GDP tells you whether the economy expanded or contracted. It can matter when a recession is the central bank's focus. So they want to get out of a recession, then they're going to look at GDP sometimes, okay? But it's not the base case every single time. The PMIs can provide a bit of a faster view on whether the economic activity is improving or deteriorating, but it's not exactly what the central banks target. It's useful for context, and hot PMIs can sometimes lead to inflation. It's all a bit connected, but don't make PMIs the priority because the central bank is going to look at inflation and not PMIs. Same goes for retail sales, housing market, confidence index. All of that is supporting evidence, because what I want you to take away from this video, from this framework, from this model, is that fundamental analysis is not about collecting all sorts of information. You know, you'll find some traders create spreadsheets with every single data point possible from an economy, and they'll start to look at everything, it's printing above or below expectations and so on and so forth. You can do that, but you have to put a lot more weight into the analysis when it's about the labor market and inflation. Those are the ones that move the needle. These are the ones that you can actually trade. If you start to chase these, you're gonna get caught in some noise. So you have to understand which information deserves your attention. And as you're understanding, it's these two. So what I also want you to understand, and we're going to complete the economic data part with this, is that one report can be sometimes volatility, while a sequence of a report, then it's a trend. Meaning, you should track the direction other than just the single number. Because imagine that inflation has been cooling for months. Suddenly there's a bit of a spike in inflation. There is just one number that prints a little bit above consensus. Is that really going to change something for the central bank? We got inflation coming down really well over the past couple of months. Just this tiny spike. Is that just noise? Most likely yes. Okay. One report can create volatility, but a sequence of report creates the trend. So when we look at the data, we have to look at in a 3-month context. What has the data trending on over the past couple of months, or the past 3 months? Has it been trending higher or lower? One single spike does not mean anything if the 3-month trend, for instance, is lower. This is what the central bank looks at, and this is what you should also look at, because as you understand, you want to be able to understand what the central bank is going to do next. They're not going to react just to a single surprising data. They're going to look at the trend. So the map is this. Before reacting to any economic data, ask what the market expected, understand how things have deviated or not from expectations, then read the details, I've shown you how you can do that with ChatGPT, for instance. Then decide whether it's mixed or clean, whether the details confirm what the headline says, and then put everything into context. Put the number into the 3-month trend. Is inflation still rising or is inflation still falling over the 3-month trend? How's it going? That. Because all of this is going to feed the core, the pillar of the decision-making framework. With all this context, you'll then understand whether the central bank next is most likely going to hike, cut, or do nothing. If this set of data, if everything here decides that, hey, maybe the central bank is going to need to hike interest rates faster than expected, great, okay. Then you need to update the view and understand that the currency is going to strengthen because of that. But let's say that everything here points to boring, points to nothing changes, well, nothing to update. Maybe either the trends are going to continue or just are going to be a little bit of chop and there's nothing to do. Sometimes that's the case. Sometimes there's nothing just to do. Okay, perfect. So at this point, you can read a central bank. You can filter the data that actually moves it, and you can compare two currencies against each other. You can understand how one currency may be more attractive versus another less attractive based on how the central bank is going to move. Now, in a calmer market, that is often enough to find a direction, but there's a caveat. And if you've traded fundamentals for any length of time, you will have already run into it. Okay? Sometimes you do the work, the Federal Reserve is hawkish, and maybe the Bank of Japan is dovish, so you expect the dollar against the Japanese yen to move higher, but then suddenly it tanks. Something happened, you cannot find it in the data does not show anything that changed, CPI is still the same, nothing, no labor market report has been printed here, no central bank has changed the context here, but yet the dollar against the Japanese yen tanked. Well, the point is that sometimes this has nothing to do with the central banks, because sometimes the market stops trading the difference between two central banks and starts trading one single risk. Now, if you remember from the first part of the video, you remember a return adjusted for what? Risk. It's not just the return, but there's also the risk variable. Because sometimes a perfectly reasonable central bank view is overwhelmed by a much larger global flow that changes the risk context, that changes the risk variable for investors. That can be a recession, that can be an inflation shock, a war, maybe a bank that is in trouble. Then currencies stop trading their own story and they trade their role, which we're going to get into right now. See, when that happens, when the risk is shaky, well, currencies stop behaving like interest rate instruments and they start behaving according to their role to the global system. Traders dump anything to rush into safe havens. They close the carry trades. So in this case, the dollar against the Japanese yen is a carry trade because the dollar has a much higher interest rate than Japan. And so when things get shaky, traders decide to start unwinding that carry because they want to own the Japanese yen because it's a safe haven. So this is the third part of the model. And honestly, it's the part that separates people who understand fundamentals from people who just think they understand fundamentals. I'm going to try to simplify this part as much as possible for you to understand each scenario, which by the way, you can already see in this table here, but we're going to get into the very details of it. So let's go step by step. Now, the retail version of the risk sentiment is often just two labels, risk on and risk off. In risk on, everybody is happy, the market is happy, it's positive risk sentiment, and risk off, everyone's scared. Okay, that's useful, yes, but it's nowhere near enough. Because you need to understand what the market is scared of. Because different fears produce different type of currency reactions. The market may be selling off because of fears of a recession, because of fears of inflation, because geopolitics are starting to heat up, or because of fear of higher interest rates. Completely different scenarios here. They're all risk-off scenarios. They all lead to the S&P 500 lower, but when it comes to currencies, that's going to be a lot different. So to understand what's going on, we're going to keep it very simple and use just one single instrument to tell us in which type of context we're in. That's the US 10-year yield. Now, earlier, if you remember, I described the 10-year yield as the bond market's view of growth, inflation, policy, and mood in general. That's exactly what makes it useful here. Because when investors think that growth is fine, they don't need to hide in government bonds, and they demand a higher return to lend money. And then the yield starts to rise. Okay, the US 10-year in this confidence growth rises. Now there's an extreme scenario in which yields can grow because of fiscal concerns, but that's an extreme scenario that often happens only in emerging markets. So I'm not going to mention here in this video to not create confusion. And then when investors get scared about the economy, maybe because of a slowdown or potential recession, then investors buy bonds for safety. And so yields, the return of those bonds, start to fall. The reason is that simple. In this scenario, the market expects potentially higher interest rates. In this scenario, the market potentially expects lower interest rates. So yields move accordingly. They encompass everything together: interest rates, growth, inflation expectations, the sentiment, everything. That is why the 10-year yield is so useful. So it's basically the market whispering itself about growth, inflation, and what the central bank is going to do next. This is your regime indicator. Now, here is the part that most traders miss, because direction is alone not enough. See, the 10-year yield drifting higher over 6 weeks does not mean the same thing as the 10-year yield exploding higher in 3 sessions. So a gentle rise, a gradual rise is not the same as a sharp rise. Same likewise, a gradual fall is not the same as a sharp fall. They have different sentiments behind it. Get this wrong and you'll do the wrong analysis on the wrong environment, okay? So follow along this section closely because it's very important. Save the next slide I'm about to show you and come back to it as many times as you need. It's gonna be a gold mine for your fundamental analysis. So this whole concept gives us this table right here. It's 4 rows, rising rapidly, rising slowly, and falling rapidly. Obviously, we're talking about the 10-year yield here. This is global macro trading compressed into a table that you can read in 10 seconds. Let me walk you through each one with what causes it, what tends to work in it, and then real examples actually to solidify the understanding so you can see it on the charts rather than just believe what I'm saying, okay? So regime 1, it's the yields rise rapidly. Now, what does rapidly mean? It means the market is freaking out a little bit here, okay? Inflation may be printed hot, or the central bank maybe came out swinging about, talking about rate hike and a cycle of rate hikes, okay? So yields rising because the Federal Reserve is expected to hike interest rates. So it's a context in which yield don't just drift slowly up, they go rocket up. And in this case, funds are very interested in what? The dollar. The dollar against often low yielding currencies, because here is where traders want that carry. They want that high interest rate from the dollar, which is expected to potentially go even higher in this regime, and they want it against low interest rate currency. Because in this scenario, imagine the yield of the dollar is moving higher rapidly, and at the same time, the yield of maybe Japan, Europe, and Switzerland is not moving as fast as the dollar is. So the rate differential, the gap, the interest rate differential between these currencies widens in favor of the dollar, and it widens fast. So let's look at, for instance, 2022. This is a textbook version to explain what's going on. Now, in this case, the Fed realized that it's got its projections about inflation wrong, and so it quickly started to hike interest rates by 75 basis points. Now, that's a big move. So, okay, often the moves are 25 basis points. A 75 basis points is twice as big as usual. So the 10-year yield, which you can see in the orange line right here, went shooting up. Obviously corrected some way along the way, but then shooting up again. It went from roughly 1.7% to 4% in just a matter of 8 months. That's rising rapidly. And as you can see, the dollar against the Japanese yen over the same windows, what it did, it followed the yields almost to the tick, from about 115 all the way to about 150, roughly 3,500 pips in 8 months. Why that happened? Because Japan kept interest rates at 0 the entire time, while the US went the other direction, and they started to blow out interest rates higher, hiking interest rates, meeting after meeting by 50 basis points, 75 basis points, pushing yields higher, pushing expectations higher, rising rapidly regime, long the dollar against low-yielding currencies. Now, think about for a second of what happens to a trader that ignores this context completely. It doesn't understand why the dollar against the Japanese yen is moving higher so rapidly. See, one important detail here is that this situation was created by a very peculiar event. Russia invades Ukraine. Now, in this type of geopolitical context, a beginner may think, oh, risk off. Risk off means buy safe havens. Yes, if you just stopped reading fundamental analysis at the first sentences, okay, and you didn't go as further as you're doing actually with this video, so well done. Now, a beginner would think this event should be cause for safe haven inflows. Not exactly, because we don't stop just at the basic of risk on and risk off. We go into understanding the yield regimes. And in this case, this context created a rising rapidly regime for yields. So it's a risk off, yes, but it's a type of risk off in which the dollar dominates, even against a safe haven like a Japanese yen and the Swiss franc. So the yen, despite being a safe haven, ended up getting sold in USD JPY, ended up rising alongside yields. Why? Because it was in a rising rapidly regime and interest rates were being hiked aggressively in the US. Now, if you were trying to short the dollar against the Japanese yen because maybe it looked overextended, or maybe you thought that the context should have favored a safe haven like the yen, you missed this part in understanding that it's the yield regime that dictates the type of sentiment we're in. It's not as simple as just risk on positive, risk on, risk off negative. There's more to it, which you are learning about in this video. So in this type of regime, what you do, you long the dollar against the Japanese yen, against the euro, against the Swiss franc, anytime you possibly can. Now, regime number 2, it's yield rising slowly. It's the same direction, but it's a completely different message from before. This is strength, but it's controlled strength, okay? Yields are up on positive growth expectations, and the Fed is keeping interest rates high, potentially maybe even hiking. I wrote here not hiking. Most of the time they're not hiking, but potentially they may be hiking. Just they're hiking slowly. They're not blowing things up, okay? They're hiking slowly or potentially not even hiking. In this case, yields grind higher slowly. This is what people call the US exceptionalism type of trade. It's the US economy doing well, rates are high, and there's basically no competition. So a high yield plus a solid economy is everything that a large investor needs to flow into the dollar, into dollar-denominated assets. So money flows into the US markets, and to move into US markets, it needs to buy dollars. So the dollar is king in this regime. In fact, you want to long the dollar against currencies where central bank is cutting. That's essentially the perfect scenario. You want to long the dollar, which has high interest rates, versus currencies that has low interest rates and potentially even keeping interest rates low. Because this is the regime where policy divergences work best. Because the gap is widening slowly, but is widening in favor of the dollar in this case. Right here, you're seeing, for instance, an example from 2024. The Fed was holding rates high and refusing to cut. Growth was still very decent. And you can see, in fact, on the 10-year yield here, it was a slow grind up. Not a vertical move, just a slow grind up. Now, at the same time, the Swiss National Bank became, in this context, the first major central bank to start cutting rates. Everyone has spent 2022 and 2023 hiking, except Japan. And the whole question in 2024 was, who actually blinked first? Well, Switzerland did. So, in this context, we had US yields grinding higher on one side, and on the other side we had Switzerland cutting interest rates. And if you look at USD against the Swiss franc, uptrend. That's what the regime was telling you to do. Rising slowly regime. Not just buy the dollar at random, but buy the dollar against the one that's easing or keeping interest rates low. In this case, the Swiss franc. Regime number 3 is yields falling slowly. And we flip the direction. Okay, from yields rising, now we go to yields falling. Why do yields fall? They fall because inflation is cooling and the economy is softening. But there's a huge distinction to make between yields falling slowly and yields falling rapidly. They fall slow, yields down because the Fed expected to cut rates, but the economy is still holding up well. No recession in this case. The labor market may be a little softer, growth may be a little slower, but nothing is breaking. Okay, there's no recession. That gives the Federal Reserve, central banks, room to ease interest rates, to cut interest rates, but not go for, emergency cuts or 50 basis point cuts and whatever. They just ease off the brake a little bit. This is what traders often call a soft landing or the Goldilocks scenario. The cost of money gets cheaper and gradually, and the economy is still doing okay. So in this case, yields fall, but they fall slowly. This is the scenario in which you want to long the S&P 500 because the economy is doing great and the cost of money is being reduced. So financial conditions are easing, which is great for stocks. And you want to short the dollar against high beta currencies like the Australian dollar, the New Zealand dollar, and the Canadian dollar. Why this flow happens? Well, it happens because funds decide to leave the safety of the dollar, which dollar is also a safe haven, and they start to go looking for return. They start to go looking for risk. So that flow goes into equities, and the S&P 500 does pretty well in this context. Often it goes into high beta currencies like the Australian dollar, the New Zealand dollar, the Canadian dollar, and often it goes into crypto as well. Anything that is pro-growth, okay? Now, let me give you an honest opinion here because I think this is useful. If you are in a falling slowly regime and you have to pick one instrument, well, in this case, the highest conviction trade is long stocks, long equities, the S&P 500, the Nasdaq, whatever you prefer. Because when yields fall slowly and the central bank is easing and the economy is still holding up well, that combination is as good as it gets for equities. And the FX version, the dollar weakens against the high betas, it still works great. But if you have to choose the index, choose the S&P 500. Okay, now we get into regime number 4, yields falling rapidly. This is the big one, okay? Maybe it's a recession, maybe it's a pandemic, maybe it's a credit event. Whatever it is, investors are scared, they're dumping everything to buy bonds for safety. This is the panic scenario. This is yields falling because people are afraid. The market is saying something is wrong. Investors are saying something is wrong. This is where carry trades get unwound and quickly, okay, violently. Because when fear shows up, protecting capitals matters more than collecting yield. Remember, return adjusted for risk. Now, here I've written that it's short the dollar against the Japanese yen, the euro, and the Swiss franc. Yes, those work, but if I want to be precise, this is going to work better with, for instance, short high beta currencies such as the Australian dollar, the New Zealand dollar, the Canadian dollar against safe havens, because it's a scenario in which investors start to flow into safe havens as aggressive as they possibly can. Now, the cleanest chart for this is March 2020. US yields crashed from around 2% all the way almost to zero in a matter of weeks. That's a violent move. The market knew the Federal Reserve was going to cut rates to the floor to save the economy, and it did. Now, in this context, if you look at the Australian dollar against the Japanese yen, it's pretty much the same as the chart of the yield, of the 10-year yield. Why? Because the Australian dollar is a high beta currency against a safe haven, and what happens when yields fall rapidly? Traders, investors flock into safe havens. The Australian dollar is a growth currency, a currency that benefits from higher growth, and the yen is a safe haven. So in these circumstances, when the world gets defensive, this pair carries the whole story in one line, okay? High beta against safe haven. Same goes for the New Zealand dollar against the Japanese yen, the Canadian dollar against the Japanese yen, or the Swiss franc as well, works right too. And so this is your cheat sheet to understand in what type of risk sentiment we're in. Yields rising rapidly, meaning inflation risks, aggressive central banks looking to hike rates aggressively. Well, that's when the dollar against the low yields such as the yen, the Swiss franc, the euro does well. Equities in this case are actually under pressure, gold is under pressure. This is risk off, yes, but don't get confused with the risk off, because this is not the kind of risk off that strengthens the safe havens such as the falling rapidly regime. This is the type of risk off that just strengthens the dollar against pretty much everything. It's a hawkish Fed type of risk-off. A risk-off that is triggered by higher interest rates. Then there's yields rising slowly. This is strength in the economy, but it's controlled strength. It's not the kind of strength that requires the Federal Reserve to hike rates aggressively. And this is what often is called the US exceptionalism. Rates stay high, but without triggering panic. Okay, so the dollar in this case stays strong, in particular against central banks, in which the central bank is maybe cutting interest rates or having interest rates low. This is where policy divergences work great. Then on the other side, there's yields falling slowly. This is the controlled cooling. It's the soft landing scenario. It's easier policy without a recession. So it's the Federal Reserve cutting interest rates, bringing interest rates lower, but with the economy still holding up well. This increases liquidity into the system, and it's great for equities such as the S&P 500, and it's great for high beta currencies such as the Australian dollar, the New Zealand dollar, and CAD, and it's great for crypto as well. And then there's the yields falling rapidly scenario. This is the growth fear scenario, the flight to safety, the carry unwind. High beta currencies get hit the hardest against the Swiss franc, the Japanese yen, the Swiss franc, and even the euro at times. This is where moves happen really, really fast. You've seen with the Australian dollar against the Japanese yen example earlier, this is roughly 1,500 pips move lower in 1 month, a month and a half, maybe even less. So screenshot this table because this is the extra knowledge that ends up making a difference in your trade decisions. Now let me connect this back to the first two parts of the model because I don't want you to walk away thinking this replaces the central bank work, okay? It doesn't, it filters it. The regime, the risk sentiment regime, the yield regime, tells you the environment. The central bank comparison still chooses the pair, okay? Here's what it looks in practice. Say your central bank analysis favors the Australian dollar. You see that the Reserve Bank of Australia is hawkish and you're bullish for the Australian dollar. Okay. If the 10-year yield is rising slowly in a healthy growth environment, then these two stories agree. The domestic story with the Reserve Bank of Australia and the global environment story pushing the same way. Confluence. The two stories agree. That's the confluence you want for your trades, and it has nothing to do with 3 indicators lining up, okay, on the chart. It has to do with the domestic context for the currency and the global macro regime in which the market is trading. When these two align, that's the best trade you can ask for. Now, look at where you are now. You know what a central bank is actually trying to solve. You know which data forces its hand and which data instead is just filing up your calendar with red folders distracting you. And you know how to read the environment sitting on top of all of it. That's the model, okay? 3 layers and they're all interconnected. But now, I have to be honest with you because this is the part where most people who learn fundamentals stop using them because doing this properly for one currency alone takes a while. Doing it for 8 currencies takes even longer, of course, which is what you actually need to do if you want to compare and find the best pair to trade with the weakest against the strongest macroeconomically. That can be overwhelming. And if you don't make it simple enough for you, you're just not going to stick with it. So now you understand the data matters, but now keeping track of everything is just a lot. So hear me out. I know artificial intelligence gets oversold constantly, and I'm not going to do that here, okay? I'm not going to tell you artificial intelligence is perfect, but at this specific task, reading a mountain of documents and organizing numbers into context is generally what artificial intelligence is best at. It's objective, it's factual, it just takes the numbers and creates what we need to do. It can find and organize all the data necessary for our type of analysis in minutes instead of what it would take you hours to do manually. So everything that you learned in the first part of the video, in the first 2 parts of the video, is now going to be baked into this one single prompt, which, by the way, is going to be a starting point. You can develop and evolve on that prompt if you need. Now, before we get into the actual full prompt, make sure you're using one of the latest AI models. In this case, I'm using the latest ChatGPT 5.6, but you may be watching this video 6 months from now, a year from now, and the latest model might be something else. What I want you to understand mostly is that you should use a model that is able to think and is able to access the web. So it finds the data we need. You don't need to necessarily use the highest thinking effort. You can use medium, but just don't use the instant mode, because the instant mode is going to be prone to hallucination a lot. Now here is the prompt. Act as an institutional macroeconomist, pull the latest core CPI inflation and labor market data for the G10 currencies over the past 3 months, summarize which economies are strengthening, inflation moving up and away from the central bank's target, labor market solid, and which are weakening. Create a useful and simple table. The data is only useful in context with what the central bank's targets and projections are. So contextualize the numbers. Very important. Now, if you analyze this prompt, you're gonna find everything that I've talked to you about in the first 2 parts of the video. This does not include the 10-year yield analysis. You still have to just look at the chart, and we'll get into later with a full example. But this includes the first 2 parts of the video. Because if you look at what we're doing here, we're looking at core CPI inflation, the labor market data for the G10 currencies, and what? Over the past 3 months. So we're putting things into context. We're making the prompt look and find for the data we need, and we're making it put things into context and historical context as well with the past 3 months. We're not looking at GDP, we're not looking at PMIs, not retail sales, not consumer confidence, none of it. We're looking at the 2 batches of data that fully matters for the central bank. Remember what we established earlier. The central bank has a legal mandate to focus on inflation and labor market data, keep prices stable and support the labor market. That's what it's obliged by law to respond and to act on. So we ask exactly for the 2 things that force a decision, and we deliberately throw out everything else because it's just going to confuse the artificial intelligence here, okay? That filter that we spent the first 2 parts of the videos working on is sitting right here in this prompt. The data that matters, the context that matters, and the context, okay? As mentioned earlier, the central banks does not focus just on one single number. They want 3 months evolution of the numbers. Is it working towards the target or away from it? How are things developing compared to what was expected by the central bank or what's being targeted by the central bank? So the data is useful only in context with what the central bank's targets and projections are. So contextualize the numbers. This single line makes all the difference. So once you hit send, it goes off and it's going to research for a few minutes and it's going to come back with a table. Now, once you have this table, you'll find out that it doesn't trade itself, okay? You have to understand how to read everything here in order to go to the chart and make a solid trade. And how to read everything here is exactly what I've explained to you the first 2 parts of the video. So what you want to do here is understand the inflation and labor market context in order to look for extremes. You want to find the currency which is the most extreme on one side with the labor market and inflation, forcing the central bank to potentially do something in particular, maybe hike, maybe cut, and find the opposite one, which is in the opposite context, forcing the central bank to do the opposite thing. So we're looking for extremes. And I mean extremes, okay? We're not looking for things that are a bit mixed on one side and things that are a bit mixed on the other side. We want to look for extremes. Now, you're not going to find always extremes. And in fact, when you don't find the extremes, you gotta need a little bit more careful. Maybe size a little bit smaller the trade, maybe be a little bit more demanding for the technical trigger to actually get into the trade. But the core basic understanding, the principle that I want you to think though, is that you want to see an economy where inflation is cooling in the labor market, maybe it's weakening a little bit, and an economy in which inflation is hot and the labor market is doing okay. That gap is what we call a macro divergence, talking about 2 economies being completely pulled on 2 completely opposite sides, forcing the central banks to go into the opposite ways, okay? And this is the essence of fundamental analysis, the strategy that you can apply immediately, right away, as long as you understand what you're doing if you watched the full video. Because The logic is essentially this. Think of two trains. Train A is moving in one direction and train B is moving in the other direction. Now the train in this case obviously is the economy of country A and the economy of country B, which means the currency of country A and the currency of country B. Now one economy is eating up, hot inflation, strong labor market data, forcing the central bank to keep interest rates high. And another economy is low inflation, labor market shaking it a bit, forcing the central bank to think about cutting rates or keep interest rates low. The gap between these two is the macro divergence. This is your trend. This is the gap and the trend that you want to trade, okay? So let me give you a real story right now. So this is just not theory. Let's look at the table as of right now. There are two currencies that stand out a bit more. We got Australia, which has trimmed mean CPI, which is in fact the central bank's focus, as I've explained you. It's not headline CPI, but it's trimmed mean CPI for Australia. That has been 3.4% 3 months ago, 3.6% 2 months ago, and 3.6% again the latest. Now, the Reserve Bank of Australia targets inflation between 2 and 3%. Trimmed mean CPI sticking at 3.6% is obviously too high. This is forcing the Reserve Bank of Australia to keep interest rates high. Now, we look at the labor market. The labor market is softening ever so slightly. Okay, the unemployment rate has been stable at 4.4%. Then it ticked higher to 4.5% in the latest. It's been weakening ever so slightly, the labor market, which is as a result the effect, obviously, of what the Reserve Bank of Australia is actually trying to do. They're trying to slow the economy down with higher interest rates to bring lower inflation, and that weakens a little bit the labor market. So this mixes things up a little bit, but the labor market is still doing okay. It's not collapsing. Now, Canada has a very strong labor market. The unemployment rate was 6.6%, then 6.5%, then 6.4%. So it's trending higher pretty well. And the average, obviously, employment report is actually doing pretty well. In fact, ChatGPT here says improving Goldilocks, probably the cleanest D10 improvement, employment accelerating while core inflation remains near target. So Canada is interesting, but it's not fantastic because the Bank of Canada is not going to hike interest rates with median and trimmed CPI, which is the Bank of Canada focused, if you watch the first part of the video, which is pretty much their target. The Bank of Canada targets the midpoint, 2% in a 1-3 band, so 2% target, and the core measures of inflation are essentially a target. They've been moving around, fluctuating over the past 3 months around target. So the Bank of Canada is not going to hike interest rates on this, but they're also not going to cut interest rates because the labor market is doing pretty well. Inflation is where they want it, the labor market is doing okay, so they're not going to cut. So we got these two interesting dynamics where we see that the Canadian dollar is interesting and the Australian dollar is interesting. They're not perfect because they got drawbacks on both sides. On one side, there's the unemployment rate, which is shaking a little bit. And on the other side, there is inflation instead that it's not perfect the way we want it. This is what we have right now. We don't have a perfectly hawkish central bank. There's the Japanese yen, yes. There's Japan that has inflation moving higher and the unemployment rate doing pretty well, so the labor market doing pretty well. In fact, ChatGPT here says strengthening reflationary best combination of rising momentum and generally tight labor market among the G10. Yes, but Japan still has very low interest rates, which is making the carry dynamic work against it. So I'm not gonna look at the Japanese yen here. We are actually long. If you follow us in the private network, you know we are actually long the Japanese yen against the Swiss franc. But it's a bit more complex because it involves understanding the Bank of Japan is interested in strengthening the yen with the Japanese governments trying to strengthen the yen via interventions. It gets complex. In this case, I want you to understand the framework, the basic framework of labor market and inflation. So Australia, potentially interesting. Canada, potentially interesting. They're not perfect, but they are in the potentially bullish bucket of currency. On the opposite side, if we want to look for a country and a currency that is weak, we have Switzerland. Now, inflation in Switzerland has been flatlining at 0.3% over the past 3 months. Now, this is the year-on-year number. Okay, this is not the month-of-month number. It's very low. It looks like the month number, but it's actually the year-on-year number. Inflation in Switzerland is very low. The Swiss National Bank defined price stability as between 0% and 2% inflation. 0.3% is pretty much at the lowest band of what they define as price stability. And they have an employment that is ticking a little higher, not collapsing, but ticking a little higher. So virtually no underlying inflation pressures and modest deterioration in the labor market. So we have a candidate, a potential candidate to short against the other two candidates, which we found being the best positioned, potentially the best positioned. Now, you can go on and analyze the whole table and look for potentially something more interesting. There's also the US dollar. The US right now, it's in a weakening disinflationary force with the labor market weakening despite the unemployment rate actually falling. If you remember, it's not just the headline. Here, ChatGPT in fact says the unemployment falling because participation has declined materially. So it's overstating the strength of the labor market. That said, for this example, let's focus on the Swiss franc against the Canadian dollar and the Australian dollar. So the context here says us that the Australian dollar is in the hawkish bucket. The Canadian dollar is in the neutral to maybe slightly hawkish bucket. They have inflation that is at the central bank's target, but they have the labor market doing pretty well. So we have one central bank that is interested in keeping rates high because they have to fight inflation. A central bank that is interested in doing nothing, keeping rates where they are, which is already 2.5%. It's already not too high, but not too low. And a country that is maybe potentially even interested in cutting rates. They're probably not going to cut, but what they want to do is definitely keep interest rates as low as possible, which right now they're sitting at 0% in Switzerland. The lowest interest rate across the board, making the Swiss franc a very nice candidate to potentially use to short against currencies that could be more attractive. And just like that, we found a potential macro divergence to trade. Hawkish against dovish. That's the Canadian dollar against the Swiss franc and the Australian dollar against the Swiss franc. Now what do? We found a macro divergence. Now it's time to look at the chart, go on TradingView, whatever you want, and start looking at the US 10-year yield. So we open up the 10-year yield chart, and what do we see here is yields, the 10-year yield, moving higher, but slowly. So what is it? It's a slowly higher regime. So it's the type of sentiment that supports potentially high beta currencies against low beta currencies. The type of regime that supports policy divergences. So we have established that yields are in this rising slowly regime. So they're not rising too fast, they're not falling too fast, they are in the rising slowly regime. The kind of regime that supports shorting a low interest currency like the Swiss franc against a high interest currency like Australia or potentially even Canada, which is not really exactly high interest currency. Australia has the highest interest rate, but that's the point. So what we did here is we found the macro divergence with the data, doing the entire analysis with the table on ChatGPT. What could have taken us 10 hours of research to get every single data point, it took 5 minutes, 11 minutes actually, with ChatGPT. So data gives the macro divergence. The divergence gives the pair and the direction to focus on. So in this case, we've established hawkish context for Australia, hawkish, not really hawkish context for Canada, but solid context for Canada, and dovish context for the Swiss franc. And then the yield regime, so analyzing what the 10-year yield is doing, tells us whether the wind is favorable for this type of trade or not. If the 10-year yield was falling rapidly, well then shorting a safe haven like the Swiss franc would not be a good idea, okay? But in this case, it's all lined up. So we have a macro thesis, and that's a thesis that you can actually monitor, can track of, and you can test with the data, okay? It's long potentially the Australian dollar or the Canadian dollar, or maybe both, against the Swiss franc. Because trimmed mean CPI in Australia is too high for the central bank to be comfortable, so they will want to stay hawkish. The labor market is not great, but it's not too bad as well. Canada, because inflation is at the target, not great. We would want to be very bullish for the Canadian dollar. We would want inflation to be rising, moving away from the central bank's target, forcing them to potentially hike, but still the labor market is doing very well, and that creates a context in which the Bank of Canada is definitely not at least interested in cutting rates. Definitely not. On the contrary, Switzerland is sitting in a very different context. Virtually no underlying inflation pressures and modest deterioration in the labor market. Now, this macro thesis that we just built is something that has meaning behind it. It's not just based on a level on a chart, it's based on the real information behind the chart. And understanding exactly the thesis allows us to also understand what could invalidate the thesis, okay? If suddenly we see inflation in Australia printing back at 3%, 3 means falling to 3%, well, that's going to move Australia away from the hawkish bucket, and we're going to not be bullish for the Australian dollar anymore. If the labor market in Canada were to start deteriorating as well, remove Canada, not bullish anymore. If CPI in Switzerland were to start rising, well, not bearish the Swiss franc anymore. You have to understand what creates the thesis, so you also understand what invalidates the thesis at any point in time. Now you can monitor the macro developments, knowing exactly what to look for. And now the calendar starts to look a lot more interesting because you know what you need to look for here. You know, for instance, that next week there is the 3 mean CPI from Australia. So if you want to be long the Australian dollar, you have to keep an eye on this to understand where it's going to fit with the narrative. If 3 mean CPI in Australia next week is going to print still at 3.6%, it's still going to be too high for the central bank to be comfortable, okay? And that's going to keep the Australian dollar in the bullish bucket that we created, in the hawkish bucket that we created. Otherwise, if it falls to 3%, let's say, unlikely, but if it does, things are going to change for the Australian dollar. So now that you understand everything about the narrative, now that you understand what makes the narrative, what breaks the narrative, now you go to the chart. So let's pull up the Australian dollar against the Swiss franc first. And what do we see? We see that it's already in a nice uptrend. Why? Because this story with hawkish context for the Reserve Bank of Australia and dovish context for the Swiss franc has been going on for a while already. In fact, we went long a couple of times with the private network in this trend. And the context is still the same. The Reserve Bank of Australia still needs to be hawkish. The Swiss National Bank still needs to be dovish. So this trend is likely going to continue. Now that we have established that, we need to start looking for bullish setup. And this is where I'm telling you, most traders start to throw away perfect fundamental analysis with the wrong entry point, okay? You find a clear divergence, you build the watch list, you pull up the Australian dollar against the Swiss franc, and it's already extremely overextended. You try to long it right here at the top and you get stopped out in a normal pullback. Or again, you try to long here and you get stopped out in a normal pullback. You need to be able to either buy low or buy when there is an important technical breakout, or potentially look at this, a nice retest of support. You just long support, buy low, sell high, aligned with the macro direction that you just established by understanding the context for Australia and understanding the context for Switzerland. So direction and timing are two completely different problems to actually solve. You need to understand the direction, which now you do, but you also need to time things correctly. And the technical timing, to be honest, can be completely simple, very simple. You don't need to overcomplicate this. You can use whatever type of model you want for the technical timing. I personally keep it very simple. I look for break of market structures like this. I look for bullish engulfing patterns like this one on the daily chart. You can see right here there's a nice bullish engulfing candle that breached the low of the previous candle and closed above the high of the previous candles. You simply long this. You may want to long a pullback after that, put the stop loss below the candle low, and then just ride the trend. As long as you align your technicals with the fundamentals direction, you're going to have that extra big, meaningful, important edge in your trading that's going to increase your win rate, increase your accuracy, you increase your confidence in the trades you take and make your trades a lot smoother. Okay, so this is the Australian dollar against the Swiss franc. As long as the context remains hawkish for the RBA and dovish for the Reserve Bank of Australia, this is going to continue gradually lower. There could be some pullbacks, but overall, going to continue higher. But once again, remember, all conditional to this context remaining the same. Okay, inflation in Australia needs to remain high. The labor market needs to stay okay. If it starts to collapse, triggering the Reserve Bank of Australia to pivot and maybe think about rate cuts, then the Australian dollar is not going to be in the bullish bucket anymore. So let's look, for instance, at the Canadian dollar against the Swiss franc now. Okay, different pair, different chart, because the Canadian dollar has not been in a hawkish context previously. It's not actually in a full hawkish context right now either, but we know it's definitely, at this moment in time, better positioned, more attractive than the Swiss franc. And if we look at the chart, we see a break of market structure, retest, and potentially this is going to continue higher as long as what? As long as the context for the Canadian dollar is going to remain the same. So inflation at the target potentially would be a lot interesting if inflation starts to move in higher in Canada with the labor market doing okay. And also same context needs to remain the same for Switzerland. So long as that continues, this also is going to continue higher. As you see, I use personally very simple technical triggers. In this case, it looks nice, it looks interesting because there's a rounded bottom with this retest of what was resistance now turning into support. It looks pretty interesting for a continuation higher. We have the macro direction, and if we look at the calendar for the important events from Canada going forward, there is GDP at the end of August, but GDP is not really what we want to care about. We want to see if there is inflation for Canada or labor market reports, and there's nothing. There's nothing interesting for Canada, which means the next batch of data for Canada is going to come at the start of September with the labor market. So there's not much that can derail actually the context right now for the Canadian dollar. So this is actually, I would say, likely to move higher into the start of September as long as the context remains the same. This is the chart work. This is the work you do on the chart. You simply look for the right timing to enter in the macro direction. Right now, I would say I prefer a little bit more the Australian dollar against the Swiss franc rather than the Canadian dollar, because the Reserve Bank of Australia has a lot more reasons to be hawkish than the Bank of Canada because inflation is a lot higher in Australia. But that's all. That is pretty much all you need to know. You understand now the fundamental part of it, and you also understand the technical side of it. And the technical side, to be honest, is very boring, meaning it's very simple. I personally don't overcomplicate the technical side because the edge, it's not there. It's important because you want to buy at the right time. You don't want to buy at the start of a pullback. You don't want to buy into an overextended market that then stops you out at a pullback. You want to buy at the right timing. So technicals are extremely important, but the fundamental direction is what gives you the real edge. And that is all there is to say about it here. You have a complete, tradable, real, verified framework that works. That's the model. That's everything. Now, let me leave you with the thing that I actually wanted to take away from these 2 hours. Most of you just learned that it isn't about finding trades everywhere. You cannot have a fundamental view for everything. You can have a fundamental view only for a few currencies at a time. And that's the objective. You want to filter out the noise. If there's no clear contrast between 2 currencies, skip it. Look for something else. Do something else. If the yield regime is fighting the context, skip it. Look for something else. Go do something else. If something does not make sense, then research it, understand a bit more to it. If it fits the framework that I've just explained to you, go ahead. High conviction trade. Go for it. Risk 0.5%, 1%, 2% on a trade. What you're comfortable with, but that's a high conviction trade, okay? Give the stop loss room, give some room to the stop loss, and then let it do its thing. But remember, patience, okay? Because the traders who blow up aren't the ones who miss trades. The other one's taking 20 positions a week with no idea why price is doing what it's doing. They're reacting to every red folder on the calendar and they're calling it fundamental analysis. You're not doing that anymore. If you watch this full video, you're not doing that anymore. You know why money moves, who's forcing it to move, which data matters, which is noise, and whether the environment is with you or against you. So the fundamental, the macro regime, whether it's actually favorable for the trade that you want to take or not. Remember, charts are the shadow, fundamentals are the object. Now go run the model. And if you like the video, this took quite a while, quite a bit of time to put together. So make sure to like it and engage so that YouTube knows this was valuable for you.